Good evening, everyone. Time for another silver update. This is the monthly chart of silver. Now, if it doesn't look quite as familiar, it's because this is silver in the Japanese yen, and it has a bit of a different pattern. It's actually more of a stable bull pattern. You can see that I've drawn the lines in of the prior tops. The top that we hit in 98 was corrected back down to in 2008, and then the top that we hit in early 2008 was corrected back down to starting in July of 2011, and now we're starting to rally out of that. This major downtrend line has been broken, and we're rounding up. You can see the MACD is about to cross. That will be one of the major crossings. You can see we haven't had a cross of the MACD all the way back to the bottom here, and then the other major cross was over here. So, and we're going to get to a question about the MACD when we get to the questions of the night. So let's jump over those because I have a lot to catch up on. So the first one is from Top Hat, and Brother John, again, thanks for all you do for the many. Seriously, thank you. I would be grateful if you would put on your best prognosticator helmet and give us your best idea. I've noticed all year the parallel tracks the Dow and silver have followed. My question is this: if there is indeed an end of the year sell-off of the market with people expecting to go over the fiscal cliff and save whatever they can by taking profits now instead of next year at higher tax rates, what do you expect of silver? Will it also experience the same sell-off as the market, or might silver do something else as people will want a different place to put their profits since silver is so undervalued and they realize what a great long-term investment it makes? Grateful, Top Hat. Well, year-end tax selling is really a phenomenon that you have in stocks and bonds, things where you have a capital gain. Silver and gold actually aren't at least physical silver and gold, and I'm assuming that that's what we're talking about here. Those are not taxed under the capital gains tax. They're actually taxed as a collectibles tax, which is a significantly higher tax. So I really don't think that the tax issue is one that impacts the physical silver and gold players. I think that for the most part, the silver stackers are people who are stacking for the long haul, and they're just looking for places to buy. I know certainly that's what I'm doing. Would love to see a drop down into the low 20s to be able to stack some more, but I doubt that we're going to get that. And next question from Lone Skater 52. Hey Brojo, I have a question for you about the final rise in the price of silver that we all know is coming. I have to say that I have a difference of opinion with you on how this final rise will take place, and I was wondering if you get your opinion on it. I have been following your website over 2 years and have seen the calls for silver to eventually hit 50, then climb to 75 for a while, hit triple digits, and then take off. I just don't see this happening. The criminal silver cartel has such a complete grip on the paper price of silver, and so few paper investors take physical delivery, that I don't see the cartel letting silver get that high as long as the paper market functions. What I see is more likely is the big crisis, a last stand by the cartel, followed by the disappearance of silver altogether. This process would start with an event in 2013, such as a major creditor nation discontinuing treasury purchases, the gold rehypothecation scandal blowing up, physical gold-silver delivery problems, a banking crisis, or any one of the many pins that can pop the bubble we live in. Following one of these events, we'll see silver get slammed down dollars in minutes into the 20s. As the uncertainty grows and the market falters, the cartel will use its last bazooka and short like we've never seen, bringing paper silver to the high teens. This will be followed by the eerie disappearance of physical silver altogether. With stupid low prices on silver, the awake insiders and strong hands will drain the last already super tight supply of silver from the newly scared weak hands. After this, silver won't have a price. It'll be so precious and scarce that you'd have to be a complete goon to sell your silver for fiat paper. As the US dollar rapidly unwinds as the world reserve currency, silver won't go from 50 to 75 to 125 and on and on. It'll just go from abundant to unattainable in any significant amount overnight. I'm aware that this scenario is specific and doesn't encompass the idea of a world economy strengthening and physical industrial demand increasing. I just think it's a more likely scenario than silver rising like in a normal bull market. It's a completely manipulated, that'll end completely manipulated as well. What do you think? Well, I don't think, if you're talking about physical silver, then yes, we might see a physical market just shut down. You could see a force majeure cash settlement and the COMEX becoming irrelevant. The LBMA or something, same thing happening over there. But as far as physical silver, I don't think you're ever going to see that. There's always going to be a black market. The one thing that governments have never been able to shut down in all of history has been the black market. There's always going to be eBay, there's always going to be Craigslist, there's always going to be coin stores. So I think it's going to be fairly easy, especially now that we have the internet. This is a different thing than the last time we had a bull market in silver in the 70s. You have a lot of price discovery that can be done through the internet, and I think you'll see a lot of new exchanges pop up if we get that sort of tightening. There's always going to be somebody willing to part with their silver, and of course the supply and demand price is set at the margin. So you're going to see those prices set, but I think they'll be a lot higher than what the paper price is. And next question, 2013 Canada Polar Bear, $8, 1.5 ounce, 4 nines, and this is from Viper 99. He posts a Drutter video where he shows that new polar bear. Now you can see from this picture here that it's actually the same size as the maple leaf. It's just that it's thicker. So it's half again as thick, and so it's a 1.5 ounce coin. Drutter says it's 24% above spot. So those are going to be a couple reasons I'm not really going to like that coin for stacking. It might be something you want to pick up as a potential numismatic play, although 24% is just too rich for me. But it might be a collector's item. But I think being extra thick, being the size that no other coin is, and being 1.5 ounces, that's just too much going against it. I don't really think it's going to be that big of a play for those reasons. Next is, what were the books on silver you recommend? Well, I thought about that a lot, and there really aren't that many. There was one that was done in the 70s, and there was one back in the 80s. I can't remember the name of that one. It had pretty good silver fundamentals. Of course, now we have the Silver Bomb, and I promote that on my blog. You can click on the link and buy that in an ebook. That's probably the best thing out there right now with the latest information. Then, of course, a lot of the articles by Charles Savoy. You can find the writings of Ted Butler. So silver's not a real popular topic with book writers, and that's not surprising. Next question, silver for debt. This is from Halo Bender. Hi BJF, thanks for what you do for both the silver community and the Bitcoin community. PMs and BTC are a couple of important and few weapons that we have against the powers that be. Your leadership is appreciated. My question lies with cashing in silver to pay off debt. I know you've discussed it in the past about how no debt, but unfortunately having no debt, but unfortunately some of us in the past have made imprudent decisions. I'm not talking about massive amount of debt, but maybe in the order of 20 to 30K, some of which is student debt. At any point a rise of silver would At any point in a rise of silver would you consider cashing some out to pay off or reduce debt? Would there be a price point, 100, 200, 300, etc., where you would take a percent of your stack and allocate towards debt? In my case, it stands now, if I cashed out my PMs, it would be the equivalent to above said debt. So if PMs doubled from today's value, I could sell half and pay off. If they tripled, a third, etc. Anyway, just a hypothetical. Well, with debt, I don't actually, a lot of people do recommend paying off all your debt. I don't necessarily recommend that. It's going to be based upon your interest rate. If your interest rate is below the inflation rate, the reported inflation rate is very, very low, maybe 2%, but the real inflation rate is probably a lot higher, anywhere from 5 to 10%. So if you've got an interest rate around 2 or 3%, it's really not in your interest to pay that off quickly, because you're actually making money from inflation. You're going to be able to pay that off with cheaper dollars in the future. Now, obviously, if you have some type of credit card or some ridiculously high interest rate, you want to get that paid off as soon as you can. But if we go into some type of default situation, then I'm assuming that if the banks close, then they may devalue the value of your bank account, but they probably would devalue your debt as well. So there are some arguments for carrying some debt, but if you do, you want to carry it at a very low interest rate. And MACD confusion. This is from OMYG Silver. Thank you for your insight and time spent on all of this for long-term stackers. When the MACD shows opposite trend short-term versus long-term, what use is the MACD? For example, using the monthly chart for silver is compared to an hourly chart showing 30 days. The 5-year sees the market average for silver being way oversold. The 30 days sees the market average is way undersold. Is there a different example in the historic marketplace that gives us a hint as to what is happening? My gut feeling is the MACD is like sticking a wet finger in the wind to feel the direction. The MACD, depending on the time scale, determines which set of players is being represented. In the longer term, all the transactions, large and small, spanning several years included, meaning more of the larger trades are factored into the average. In the short term, more of the smaller players in the group. The MACD that covers several years would more accurately follow the manipulation of paper silver. The short-term MACD has fewer or none of the large trades and consists mostly of small players, etc. So I've pointed out before, and let's go back to the silver chart, the MACD is strictly a trend following indicator. So in this time frame here, where you've got flatline choppiness, obviously the MACD is not going to help you at all. But if you're looking at the MACD on the longer term view, you already have a bullish view on this market and you're buying for the long term, then the MACD is very useful in a trending market. That's going to give you a buy signal here. It's going to give you another buy signal here, and it's very soon going to give you another buy signal if it crosses over to the upside. Now, if we go to something like Apple, which is a stock I've been following for a long time, this one trended up for a very long time, and if we pull it back to, say, the daily, because it's such a long-term trend there, you can see that the daily was very useful for picking buy points. You had one here, you had one here, you got a good one there, another one here, here, and now we're starting to roll over. So I certainly don't recommend taking them anymore, but at least during this rise, there's another one there. These were all very good buy signals. These were all very good entry points into this market. Now, the question is, if this market is actually rolling over, then are the sell signals accurate? We have a sell signal there, we have a sell signal there, and now we're getting a sell signal here. So if it is rolling over, then the sell signals are going to be accurate and the buy signals aren't going to be accurate. This is one of the biggest buy signals we've had, and yet it appears that we're rolling over and going to fail. If that's the case, then we're going to be entering a downtrending market, and then you're going to be taking the sell signals and ignoring the buy signals. So that's how you use the MACD. In a bull market, you ignore the sell signals and use the buy signals, and you do the opposite in a bear market. And next question, silver and gold. Hi John, your commentaries are great. Kudos to you, sir. When talking to the few friends that I know that stack, they'll always ask me, well, when are you going to sell? My response is, and this is where I'd like to hear your opinion, I don't plan on selling. I'm trying to create generational wealth, so if I don't need to use it in my lifetime, I'll pass it on to my daughter. With that said, though, I would consider trading it for gold if the ratio closes to 5 to 1 or better. Do you think this would be a good move, especially if silver makes a fast run up? Well, that gets back to the other question, and I do agree with that. That's my plan. I believe that probably I'm looking at 10 to 1 would be the ratio that I would start to do a little bit of swapping of silver for gold, and then maybe a little bit more at 5 to 1, and then watch to see if we get to 1 to 1, and try to get to maybe a 50-50 gold and silver split. I think I'm probably at about a 95-5 or 99-1, something like that right now. So that's what I'll be looking at doing before I'm looking at selling anything. I'll be looking at swapping for gold. And the last one here, actually I think we got a couple more. Huge cash position. Hi, Brother John. Came across this video and it raised some questions for me. He calls for a 50% cash position in cash and a much smaller position in PMs. You always do a great job analyzing videos. If you have the time, it would be greatly appreciated. Well, this is a link to a Jim Rickards video. And you have to remember that if you're talking about a cash position, most of the time when people are talking about going to cash, they're talking about moving from long stocks to cash. So the bias in the stock market is always perma bullishness. It's never negative. It's never shorting. It's just how long you are. And when they say move to cash position, they're talking about say a 50% cash position. That means you're 50% stocks, 50% cash. Now with gold and silver, I would say that that's going to be based upon how much cash you're talking about. If you're talking about a person who has $100,000, well, let's start with a person who has $10,000. If you're talking about a person who has $10,000 and they've got $5,000 in gold and silver and $5,000 in cash, that might be a good ratio, because your cash is going to be for emergencies. It's going to be for getting through a banking crisis. Now, if you bump that up to $100,000, would I recommend, or would I, for myself, because I can't make recommendations, would I desire to have $50,000 in cash and $50,000 in precious metals? No. For me, that would move closer to 80 to 20 or 90 to 10. And then if you were talking about, say, $1 million, then you're going to be talking about, I would be looking at maybe 95% of that $1 million being in precious metals and only 5% being in cash. So as you have more money, if you're trying to just have cash for safety's sake, then, or to get you through a crisis, then obviously the amount percentage-wise of cash is going to go down as you go up in having more money. And the last one I'll do, this is Martin Armstrong on hyperinflation in the USA. Martin Armstrong says Germany went into hyperinflation because it had reparation payments it could not make. Real wealth was fleeing. This is why even John Maynard Keynes argued against that. The actions against Germany were punitive and would do more harm than good. On that score, he was correct. Germany had no choice but to print money. Hyperinflation cannot take place until you reach that point of no return. As long as there are still bond markets and buyers, we will not see hyperinflation anywhere. Eliminate the bond buyers, real wealth flees, and what is left is only printing to make ends meet. So if the Fed won't go away and will always buy the bonds of the USA, will there be no hyperinflation? As the few who tell us what will happen may not happen at all. Will it be slow grinding poverty to where 150 million people are on food stamps? Well, I can't say I necessarily agree with that. When you say there are no bond buyers, does that count the Fed in that? Because I think we're at the point now where the Fed is buying the majority of the bonds. Now, if the Fed is buying the majority of the bonds, it's possible that they will be able to sterilize that money. That's pretty much what they've done so far. They've done it so far to the extent that I would say that they have slowed down the rise in gold and silver. But if we look at the gold market, I wouldn't say that that is in any way contained. That's definitely a very, very strong bull market, and to me would be an indication of the failure of the Fed at its mission. So I think the German situation and our current situation are actually a lot closer than most people think. We're not paying reparations, but we are paying interest payments to the Chinese and to others. And eventually, I think if they keep following that path, we're going to end up in the same place that the Germans did. Now let's get over to the story of the night real quick. I don't have a lot of time left because of all the questions, but if you remember when I did the video on the public trough talking about all of the public workers, that was about Chicago and Illinois and the very, very high pay of those government workers there. Then if you remember, I did the video on San Bernardino and covered the amount of workers that work for the government there. And I didn't go into the pay. I suspect it's not nearly as high. But you can see that a frightening number of workers are working for the government. So the question is, when we talk about the fiscal cliff coming up and the tax increases, now to me it's just insane that they're talking about tax increases. That's only going to slow down the economy more. What they should be talking about is massive spending cuts, and you take the pain. As Peter Schiff says, we need to go over the fiscal cliff sooner rather than later and face the pain. But of course, politicians aren't going to do that. They're going to kick the can down the road. But the big question is going to be, what is going to be the impact of these tax increases? And it's going to be my contention that when we look at these tax increases, this is the effective income tax rates, and you can see that when we get to the top 10%, top 5, and top 1%, you're talking about an effective 20% tax rate, same as the highest here. So this is going to be the point that Obama and the Democrats are talking about. They want to tax people above that. Now, I suspect if you're talking about income, then the people that have incomes above this is not going to be a large enough number to make any kind of difference. But so we're either going to go over the fiscal cliff and it's going to affect everybody, or they're probably going to have to push that down into this fourth, third, or possibly even second quintile of taxpayers. And so we're probably looking at across the board tax increases. Now the question comes up, if we're in a situation where such a large number of workers work for the government and also the pay and benefits for those is skewed much, much higher than the private sector, then if we see tax increases in this order, isn't that going to be a form of backdoor austerity? In other words, won't those tax increases fall primarily upon those higher wage earning government workers? And as if Lindsey Williams is correct, by the end of 4 years, 70% of the people will be working for the government. Then effectively, tax increases are going to amount to backdoor austerity, because they're going to be giving them with one hand either pay raises or continued high pay, and with the other hand they're going to be taking away that pay with tax increases. So as you can see, there's really no way to win the game once the majority of people are riding in that cart. Then there's nobody left to tax except for them. So that's how we're going to see austerity, in my opinion. It's going to begin with increased taxes, and a lot of the people who work for the government are going to find that it's going to land on them. So back to the charts. We're waiting for silver. We did the Japanese yen cross of the MACD. We're waiting also for the dollar silver cross. We're at about the same. The big difference we can see here with the dollar silver price as opposed to the yen silver price is that the yen silver price corrected all the way back to that and actually went lower, but the dollar price has not. Both of them, though, are attempting to make the next crossover of the MACD, and that's going to be about a 3-year cross since we've had that, and hopefully that's going to portend a run up towards that $50 price, and we'll talk to you next time.